What if I told you a man could lose a $47 billion company, file for bankruptcy, get fired in public, and still walk away a billionaire? No fraud, no prison, just leverage, ego, and a broken IPO. This is not just a startup story. This is a venture capital fever dream. This is what happens when cheap money meets unchecked ambition. This is the rise and implosion of Adam Neumann. And by the end of this video, you'll understand why valuation is not wealth and why the stock market eventually demands the truth. Let's begin. Welcome to DollarPreneur. 2010, New York City. Neumann wasn't selling office space, he was selling belonging. He said, "We are elevating the world's consciousness." Pause there, because anytime a commercial real estate company sounds like a spiritual movement, you should pay attention. He and Miguel McKelvey launched WeWork. The model looked simple: long-term leases, short-term desk rentals, community branding. But here's the tension: long-term liabilities, short-term revenue. That mismatch is small in a bull market, it's deadly in a downturn, and nobody cared. Yet. The timing was perfect. Interest rates were low, liquidity was everywhere. Venture capital firms were hunting unicorns. WeWork positioned itself as a tech startup, not a landlord. They called it space as a service. That phrase probably added billions of dollars to the startup valuation. By 2016, WeWork hit $16 billion. Still no profit, but growth was explosive, and growth hides flaws for a while. But here's the question: what happens when growth slows? Hold that thought. Then came the turning point. Masayoshi Son, the mastermind behind SoftBank. Through the Vision Fund, he deployed historic levels of capital. He didn't invest $100 million, he invested billions, over $10 billion into WeWork. And when you pour gasoline on ambition, it explodes. Expansion went global: China, India, Latin America. Valuation: $47 billion in 2018. Let that sink in. A commercial real estate arbitrage company valued like enterprise software. But here's the trap: private markets can price dreams, public markets price cash flow, and that difference was coming. Success changed Neumann, or maybe it revealed him. Private jet, luxury mansions, he cashed out hundreds of millions of dollars before IPO. That detail matters. He trademarked We, sold it back to the company for $5.9 million. Corporate governance experts started raising eyebrows. He personally owned buildings, leased them back to WeWork. Related party transactions, super voting shares. He controlled the company. Investors carried the risk. That imbalance doesn't show immediately. It shows at liquidity events, and one was approaching. In 2019, WeWork files their S1. This is where storytelling meets accounting. Wall Street analysts read the numbers. Losses? Nearly $2 billion in 1 year. Lease obligations? Tens of billions. Cash burn? Extreme. No clear path to profitability. Suddenly, the narrative shifted. This wasn't SaaS margins. This was leveraged commercial real estate in a tech costume. Valuation collapsed. $47 billion, then $20 billion, then under $10 billion in weeks. The IPO was pulled. That was the real crush, not bankruptcy. The IPO humiliation, because once public investors reject you, the illusion breaks. And then the board moved. September 2019, Adam Neumann was forced out. The visionary founder removed before the bell rang. But here's the twist. He walked away with over $1 billion. Stock sales, loans, exit packages. Employees had equity dilution. He had liquidity. That's the difference between valuation and wealth. Remember that. Then came COVID. Offices shut down, remote work exploded. Month-to-month tenants disappeared, but lease obligations stayed. Debt mounted, cash flow shrank. In 2021, WeWork went public through a SPAC. Valuation around $9 billion. The stock market wasn't convinced. Shares fell over 90%. Layoffs followed. Asset sales followed, restructuring followed, and in 2023, bankruptcy protection. A $47 billion empire collapsed. You think that's the end? It isn't. In 2022, Andre Horowitz invested in Neumann's new company, Flow. Valuation $1 billion before full launch. That's founder mystique. Some investors bet on spreadsheets, others bet on personality, and sometimes personality wins. Here's the real lesson. Growth without profit is temporary. Venture capital magnifies ego. Corporate governance protects founders from themselves. And startup valuation is not the same as enterprise value. From 2010 to 2023, Adam Neumann built one of the fastest scaling startups in history, raised over $20 billion in venture capital and private equity funding, hit $47 billion, lost control, watched bankruptcy unfold, and still remained wealthy. Some founders lose everything. Some lose the company. Very few lose both. That's the difference between narrative and numbers, and the stock market always chooses numbers.